Donating to charities can provide two important benefits. It allows you to support causes close to your heart, and it can provide significant income tax benefits. However, it doesn't always work out this way. Without proper planning, the income tax deduction associated with your charitable giving could be limited, or worse yet, completely eliminated. In this video, I'll be discussing 4 ways you can structure your charitable giving to maximize the related income tax benefits. So if you want to avoid wasting income tax deductions, you're going to want to watch this video. Hi, my name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. Before we dive into the 4 specific strategies, I wanted to briefly discuss how charitable donations are deductible for income tax purposes. Now, I probably don't need to tell you this, but taxes are complicated, and I'll be painting with some pretty broad strokes here. So don't consider this individual income tax advice. But this is important information that you may want to learn and incorporate into your own income tax planning. When calculating their taxable income, U.S. taxpayers are allowed to use either the standard deduction or they are allowed to itemize their deductions. The big 3 itemized deductions are state and local income tax. Now that's typically property tax or state income tax, the mortgage interest deduction, and finally, charitable giving. In 2024, the standard deduction for a married filing jointly couple is about $30,000. This means in order to qualify for itemizing your deductions, you would need over $30,000 worth of those itemized deductions. Now, it used to be easier to itemize. However, as part of the 2017 Tax Cuts and Jobs Act, the standard deduction was raised and the state and local income tax deduction was capped at $10,000. This shift has made it much harder for taxpayers to itemize their deductions. Let's go through an example. In this example, we'll take a married filing jointly couple that has taxable income of $300,000 per year. As a result of that taxable income, they have state income tax of $27,000 per year. They own their own home that's worth about $1.5 million and pay property taxes of $12,000 a year. They also have a mortgage on which they paid $15,000 of mortgage interest last year. So adding the state and local income tax, they've paid $39,000. However, because of the SALT cap at $10,000, they will only get a $10,000 deduction for that amount. Add that to their mortgage interest of $15,000, and they have a total itemized deductions of $25,000. This couple also donates $6,000 to a local charity, bringing their total itemized deductions to $31,000. So if they did contribute that $6,000 to charity, they would have received the $30,000 standard deduction because they didn't have enough itemized deductions in order to itemize. But the $6,000 in donations brings it to $31,000, which increases their deductions from the standard deduction by $1,000. So let's highlight that. They gave $6,000 to charity, but only received a $1,000 deduction. That almost doesn't feel fair, right? But let's try something a little different. Let's say we have the exact same year, 2 years in a row. Now, limits and tax rates and things like that will change from year to year incrementally, but for the purpose of keeping this very simple, let's just say we have the exact same 2 years. But rather than donating $6,000 in each year, we decide to take $12,000 in charitable donations in 1 year and use the standard deduction in year 2. So the $12,000 plus the $25,000 gets us to $37,000 in itemized deductions. Then, in the following year, we won't use any of the charitable contributions and just take the standard deduction of $30,000. So remember what happened in our first example. We donated $6,000, but only received $1,000 of incremental tax deduction. So by bunching those donations together, we got a $7,000 deduction. Whereas if we took each $6,000 a year independently, we would only have a $2,000 deduction. So this illustrates strategy number 1. Bunching your deductions. If you plan on giving a certain amount over the next few years, it may make sense to see if grouping or bunching those deductions within 1 year will provide a bigger tax benefit than paying those out over several years. As our example showed, bunching deductions can be a very powerful way to ensure that you're getting the tax deduction for your charitable contributions. Number 2, a donor-advised fund. A donor-advised fund is kind of like a charitable investment fund. In the year in which you contribute to a donor-advised fund, you are entitled to take the income tax deduction. Then you can use the proceeds within that fund to fund charities over multiple years. While the funds are in the account, waiting to be donated to charities, they can be invested and grow. This will hopefully allow you to donate even more to charities down the line. One way to think of a donor-advised fund is kind of like a prepaid charity account. You earn the tax deduction in the year that you fund the account, which gives you tremendous control over when you can recognize the income tax deduction. But then you can donate to charities out of that account anytime you wish to do so. But make no mistake about it, once you've put that money into that account, that money is essentially gone. You recognize the donation on your income tax return, so that gift has been completed, and you can only give those funds to charities going forward. Now, just about every custodian that has a household name has a charitable fund capability. But if you're interested in as much of the funds as possible going to charities, then you're going to want to make sure that you understand the fee structure at both the fund level and the investment level within the fund. So before selecting which custodian to use, make sure you understand the fee structure. Donor-advised funds are great because they provide an immediate income tax deduction. They also provide flexibility in the timing of your donation and the specific charity to which you choose to donate. And finally, while you're waiting to make those donations, the balance in the donor-advised fund account can grow via the investments. So donor-advised funds are a great tool to use in order to maximize your charitable deductions. Number 3, donations of appreciated stock. Donations of appreciated stock are a very tax-efficient way to give to charity. For example, let's say you purchase some shares of stock for $5,000, and now that stock is worth $100,000. If you donated that entire position to charity, you could recognize a $100,000 charitable deduction without recognizing the related capital gain. So that $95,000 capital gain essentially disappears when you donate that stock to charity. Now, there are certain taxable income limitations that you have to be under when it comes to donating appreciated stocks to a charity. So make sure you familiarize yourself with those limits prior to using this strategy. But if you meet these rules, donating appreciated stock can help you do several different things. It can maximize the value of your charitable donation. It can eliminate having to recognize the related capital gain on the sale of those securities. You can use this to rebalance your portfolio without having to recognize any taxable gains. And finally, this can be a very effective way of reducing concentration risk in any one particular security. And if you really felt like supercharging your charitable giving, you could donate your highly appreciated stock to your donor-advised fund. So make sure you keep these strategies in mind. Number 4, qualified charitable distributions, or QCDs. For individuals aged 70 and a half and older, QCDs offer a way to donate to charity directly from your individual retirement account, or IRA. In 2024, this limit is $105,000. And you can do this without recognizing the distribution as income. Now, this is completely different than taking a deduction on the income tax return. Rather, a taxpayer is able to donate directly from their IRA to their charity. That donation will also help satisfy any required minimum distribution, or RMD, that the taxpayer might have for that particular year. Meaning that if the QCD you donated to a charity was greater than your required minimum distribution, then no additional required minimum distributions needs to be taken. But the beauty of a QCD is that the taxpayer doesn't recognize the income for the amount of the distribution. So this can be a great way to help you navigate around the taxable income associated with required minimum distributions. Now, you might be saying to yourself, JP, I subscribe to your channel and I watch a lot of your videos. And I know that RMDs don't start till age 73. And yes, that is correct. But that is the beauty of the QCD starting at age 70 and a half. This can give you a head start where you can make these charitable donations directly from your IRA and reduce the RMDs that are going to happen in the future. So the benefits of this strategy are that they reduce your required minimum distributions, and they're not included in your taxable income. This can be particularly helpful for retirees when it comes to considering IRMA surcharges or the taxability of your Social Security benefits. But remember, there are a couple limitations. You must be older than 70 and a half, and the ability to do this is limited to IRAs. So those are the 4 strategies: bunching donations, using donor-advised funds, donating appreciated stock, and qualified charitable distributions. Now, you don't necessarily need to use these in silos. As I pointed out earlier in the video, you can combine these to even create greater income tax benefit. So if you're interested in using these strategies, talk with your CPA or CFP about how they can be incorporated into your financial plan. Any charitable giving strategy should be part of a comprehensive financial plan. I did a video on what goes into a comprehensive retirement plan, and you can see that video here. Thanks for watching. If you like this video, please hit like or subscribe. Thanks again for watching, and I'll see you next time.